Hey, welcome back to Dirty Boots Capital. I am your host, Tony Lopes, and I am here with the amazing Christian Osgood. Christian, welcome to the Dirty Boots Capital podcast.
Hello, hello. Thanks for having me on.
Yeah, this is going to be great. So, Christian, for folks that don't know Christian Osgood, go look him up. He's like a social media rock star. In addition to being a real estate rock star, he has over 200 units under management, and he's only 32 years old, which is amazing. I don't think I got started until I was about 30 years old. So, man, you have such a head start on me. It's amazing. I'm really happy for you, all that you've accomplished. So he's also in front of a website called Multifamily Strategy. So take a look at what they offer there, multifamilystrategy.com. That's the web address. Go see what he's doing out there. He has some offerings, and just see how he can help you get better at doing real estate investing. So he's done it. He's had tremendous success. Definitely accredited to be able to be the authority on the subject. That's why we have him on this podcast, because we want to get his thoughts on pain points that we are facing today. And I know a lot of you out there listening to this or watching this that are into real estate investing, we're all facing this in some way, form, or another. So I want to talk about pain points, in particular, three particular pain points we're facing today. First one is funding. How do we find funding for a deal? So Christian is going to bring us up to speed on that, how he's bringing things together. The second pain point is going to be cash flow. A lot of us are seeing and hearing, and we run numbers, and finding a property that cash flows can be difficult today. So we're going to talk a little bit about that pain point with Christian. And then lastly, I want to talk about the pain point relative to dealing with tenants. If you've been in this business for any amount of time, we all have stories about tenants, and I'm sure Christian is no different. So I want to get his thoughts on how to best manage tenants. And through these, talking about these three pain points, our goal is to add value to those real estate investors out there, current real estate investors and new real estate investors, to be able to give you some real value on how to deal with these pain points. So first, Christian, let's dive into the first one. Funding these days, with the interest rates being what they are, and especially if you're buying it in a commercial loan, what are you finding for the best ways to fund a real estate deal these days?
So, best way to fund a real estate. And the funny thing is, I was doing this when interest rates were low too. Of the last 20 deals I did, 17 of them were seller financed. And a lot of these anywhere from 0 to 10% down. So doing a lot of deals low down, because I start with no money. So for me, there are three things you have to hit. You either borrow less money, but that means you have to have more money to put down. If that's not you, that one doesn't really help. But you borrow less money, you borrow cheaper money, which is where creative finance and seller finance has been a tool that I really like. But there's a lot of ways to use creative finance to lower the interest rate. And then you have to raise enough in reserves. We're going to touch on this, I think, later with the cash flowing deal piece. I think a lot of people's deals don't cash flow because they don't factor the reserve. So the property is always eating the monthly cash flow. But if you do a deal where you factor for those three things, right? Like, hey, I wrote a deal that cash flows on long-term cash flowing fixed rate debt, and I have enough in reserve, every time you close a deal, your income goes up. When we were at 3.5% interest rates, I was closing deals at 6% seller finance, and people are like, dude, you're crazy. I'm like, well, it's fixed rate debt, cash flows. These deals work. And they were deals that might not be funded by a bank. Fast forward to now I have this great locked in 6% debt when rates got all the way up into the eights for a little while. I'm loving those debt products.
Yeah.
They work really well. A debt product that works for your deal. I actually have a deal that was 5% interest, but it didn't cash flow. We did seller financing. I rarely recommend this as a tool for this deal. We won on price by a ton. Income was low day one. They were stuck on, hey, we need 5% interest. We did a reverse AM for the first 2 years. It adds $50,000 to the principal balance by having payments less than the interest rate. However, I would have bought the deal at $2,050,000. The extra $50,000 it adds, I just did the math as if we bought it at that price. It's worth about $2.5 million. So I'm like, okay, instead of a $500,000 discount, we're going to write this like we're getting a $450,000 discount, but we're writing it where it always cash flows so we don't have to inject more money into the deal. Structures like that have been a fantastic way to fund a deal. I found that if you have relationships with those owners, your odds of getting lower down and getting seller financing, it is a direct to owner strategy that I think works the best for this type of financing. Banks are loosening up just a little bit.
Yeah, and I think no, I mean, one of the things I want to kind of touch on, you said relationship. Some of these things don't, right? They don't fall on day one. It's about creating a relationship with people. And this can be very local. I chat with some folks who are looking like in different states, and yes, you can do that, but don't drive yourself crazy. I mean, look locally and go have a cup of coffee with people to talk about, hey, I see you've owned that property for the last 20 years. Are you thinking about selling it? I'd love to be able to buy it. I'm a real estate investor. I'm looking to do good for the community. And what? Placing that money, like once you sell it, placing that money is going to be a hard thing. I mean, what if I gave you like 5% interest for the next, 5 years or 6 years? Would that be interesting to you? I mean, where are they going to go find 5% interest? I mean,
Mhm.
maybe they could put it in treasuries and get 5% short-term, 4-week, 8-week treasuries are paying about that. But you're not going to get it in a bank.
No.
Certainly not going to get it there. Or you could put it in the stock market. And the stock market is kind of like, okay, we're at an all-time high now, and where's the future going to be? We've been riding this bull market for so long. Eventually, it's going to be a bear market. And do you want to put your life savings in terms of all that appreciation you gained over 20 years holding a building? Do you want to put that into the market where you're going to lose? Being able to speak with some of these investors over a cup of coffee and say, hey, I'm willing to pay you 5%, really safe over the next, 5 years, 6 years, whatever works for you as that real estate investor. I mean, every case is different. What works for me is different than what works for Christian, what works for some of the viewers out there. So you really have to do a case by case.
Yeah, I have two things that will help work for everyone. Number one, never treat someone like a seller. Treat every owner like an owner. I think there's a ton of content online, though, where they're saying, hey, look for these distressed properties. Look for the worst property in the best neighborhood. You hear this on Bigger Pockets all the time. You hear this from a lot of online and people. It's like, hey, look for distressed properties. Well, the problem with distressed properties is they're usually owners in financial distress. I've found that if you're looking for preferable terms and you're looking to stack the deck in your favor, look for the people in your market who've already done what it is that you want to do.
Yeah.
If you come in and you're like, okay, and I've done this with multiple people who have hundreds of rentals in my small little markets I invest in, Central Washington, Central Texas. It's the people who I've met with to learn how they built their business. I've had this happen 5 times where they've plopped me in their truck and they've driven around their portfolio and they told me the story of how they started. And we went property to property. This is how I bought this one. This is where I learned to partner. Oh, guess how I did this deal? This was super creative. You should know this. I learned how to play the game from people who had already done exactly what I want to do. I think it's the most logical way to buy. All of them told me to buy on cash flow. So when they eventually, at some point, most of them proposed the deal at some point, maybe a property that's too small for them, maybe they're 1031ing up. One thing, if they're winning the game, they already usually have money. So they're not someone who needs to be, if you have 100 rentals, you usually don't need to be cashed out. If you've held that for any amount of time, you've already hit a significant amount of wealth. So you're working with people who have capital. They don't need to be cashed out. They're able to look at a longer time horizon and they understand the rules. If you learned from them how to cash flow a deal, it would be super weird for them to pitch you a deal that doesn't cash flow. They're like, always buy on cash flow. That was my rule. And they pitch you a deal. It's like, well, you did say always buy on cash flow. And then I've had deals where they're like, well, it's 10% down, so it's pretty highly leveraged. They actually write the interest rate specifically to where it will cash flow. So we sit with them, we do the underwrite with them. Those, I think, are the strongest possible relationships you can have. And as an added bonus, those are the people who know the best lawyer, the best property manager, the best everything in the market. They've already built the business that you're trying to build. Just learn how to do it from them. And it's also probably the best source of deal flow. I think you can get super creative if you do that.
It sounds so easy, yet I still find people who bang their head against the wall and try to recreate that wheel. It's just it just blows my mind, really. One thing I want to touch on relative to funding a deal, and then we'll move off this one, but I like the ideas you gave. Just working with somebody who's already done what you want to do. I mean, that's super important. So many skills. Fast forward your buying process, just doing that is going to be huge. Seller financing is a great creative way to do it. What about doing a JV deal, like a joint venture, a JV deal with somebody else, bringing a partner that maybe if you don't have all of the down payment, bringing somebody in a partnership manner to be able to do like a 50-50 share of that cash flow. Have you ever done JV deals?
JV's how I've done a majority of my deals. So the simple order to funding capital is deal, then debt, then equity. I believe it's always in that order. I think too many people, especially if you start with no money, like I did, you really worry about like, what if I get this under contract and I don't find the money? And that's where a lot of people stop their adventure.
Yep.
If you go and you find people, and some people are really good social people. So the raising capital is the easy part. They're like, I have all these people who want to invest in me, but I don't have a deal yet. It's like, well, those people are going to burn out. Those people are going to, if you have people who are like, I'll place money with you at 12%. Now you can only look at deals that cash flow over 12% day one. That's the only way to do it. If you find an amazing opportunity though, then you find the debt product. Maybe it's seller financed. The deal that I'm buying now, it's bank financed, 80% LTV, which is great in this market.
Yep.
We're looking at about a 6% interest rate. It's on a lower income. It's on a LIHTC property. So you actually get a little bit
Yep.
lower than market interest rate on these. I've already financed 80% of the deal. I found the opportunity. It's a fantastic price. Cash flows day one. I have a debt product. Now I'm coming to the equity partner with, hey, I've already done 80% of the deal. The deal's basically put together. I'm looking for someone to bring in the money, the last 20% of this deal
Yeah.
to kick us across the finish line. I rarely give 50% of a deal. But my goal there's two partnership structures I use very often. In a JV, if it's a longer term strategic partner, of which I have very few, I like to own all my real estate myself at some point. On a longer term strategy, I usually write it in a way where there is a goal to do a cash out refinance in the future and make sure that both of us have no money in the deal. So I generally on those don't pay myself anything. They get all cash flow and they get all money out of a refi until all accounts are balanced at zero. Let's say they own 25% of the deal. I found the
Yep.
deal. I found the debt. I did all of the work, or at least 90% of the work. And then at the end, their cash comes out. I get 75% and they get a keep as a residual, say 25% of the LLC. They have no money in it. They own 25% of a commercial building. They're usually pretty happy with that. If your goal,
Who wouldn't be?
exactly. And you can give less equity that way. That's a legitimate way to give less
Yeah.
equity. If there's not enough equity in the deal day one to back the amount of money they put in by, say, 25% of the deal, you can simply back it by your equity as well. You can say, hey, if we fail to pay you out by X period of time, then I surrender X amount of equity. So you can still back them by adequate collateral, which is really important. I don't want people to listen to this and be like, wow, I can just under collateralize a deal. You need to make sure that their money is safe. Back them by enough equity in the deal, but you don't need to give them more equity. You can support it with your own equity, which is for some is a foreign concept. The other strategy, and this is most of my deals, I think this is a simple way to do it. If you have a deal that has enough upside to buy them out with a multiple on their money. So say I have a deal, cash flow is a little light day one, but there's a ton of rental upside. So I can increase the income. It can support debt later. What I'll do is I'll bring on someone. They'll do the down payment. I'll let all the cash flow just go back into the deal. I like doing that so that all my accounts just stay liquid on the project. I can do a buyout, say a 1.5 on their money in 3 years. If it's a property where we have significant upside, I put an option to purchase them out at a fixed price in a fixed period of time. And the goal is for the real estate to buy the real estate.
Mhm.
And I do that all the time. So it's, hey, neither of us are taking distributions. This is a 3-year hold for you. We're going to give you a 1.5 on your money, or sometimes I'll double people's money in 5 years. Yeah. These are all reasonable targets. Are you 10% down? I did this on duplexes, 3 side-by-side duplexes. I needed 90K down. I paid them out 180. I dominated on price. The cash flow is just a little low. They did not do a good job with market rents. I brought the rents up. Cash flow fed the LLC. I upgraded the buildings out of cash flow from the buildings. We pulled 200 out of the properties. I paid myself 20. I paid them 180. Now I own 3 side-by-side cash flowing duplexes. I never spent $1 out of my pocket. I paid myself to own them $20,000. And now I just have them all by myself. There's 2 JV structures that work phenomenally that give you the lion's share of the equity.
Yeah.
Personally, I'm not a syndicator. I like JV structures when I can use them better. If you can structure as a JV, you have a little bit more creativity, a little bit more freedom in how you operate. There's less regulation, and you can often get a larger chunk of the equity. I'm not anti-syndication, but I like to figure out. It's a last resort. I haven't had to use it yet, but for me, many people go to that as they scale. I would push as far as you can on solo deals or small JVs before you ever look at that. If you've seen these online where people are like, start out with a 200-unit building, that was a great way to lose yourself and all of your friends and family a lot of money.
And especially if you're not experienced. If
Yes.
that's your first real estate deal, wow, there's a lot of learning yet to happen. And that second JV deal, the way you structured it is, I think, very smart. And for a lot of people who are just starting out, who don't have the down payment or all the down payment, may work very well. Because a lot of these first-time investors or newer investors looking for whether it's a first, second, third, or fourth property, something like that, newer investors, where you don't have that down payment, chances are you're probably still working your W-2 job. And that's okay. That's how I got started. Yeah. So that's good. You don't need the cash flow, so to speak, on day one. It's important, as Christian said, the property needs the cash flow because that cash flow is being built up in reserves to go off and pay the JV partner after 3 years, whatever that term you said is going to be, it goes to pay that off. So it needs the cash flow. But if you can purchase a property and not take any cash flow yourself, just let it build up in a reserve account, you still got your W-2. Your W-2 is still putting food on your table at home and clothes on your back. So that's a good thing. But then in 3 years, that's when the payday comes.
Yep.
Because to Christian's point, you have zero or low dollars in the deal. It's basically an infinite return at that point because now you've bought out the JV partner per the contract, they've exited,
Hmm.
and you now own the property free of that JV. And now that cash flow is coming to you 3 years later. And that's okay because you've had your W-2 job to be able to go ahead and still put food on the table. So that's very creative. I love that. And I want to move on to cash flow because our time is short here and I want to make sure we get all three of these. So
Yes.
funding, some good creative important ideas there. Cash flow. You've already touched on it, how important it is. And we're the same way. We don't do a deal unless the cash flows on day one. And I know a bunch of other folks who do the same thing. Nobody's the smart people in the industry today buying real estate aren't buying it for appreciation today. You got to buy it for cash flow.
Yeah, but
That's how I've
you'll get
always
rich
done
off
it.
appreciation, but buy for appreciation based on cash flow.
Yeah, you
It
gotta
cash
have
flows and
number one.
it will keep paying you until it appreciates. That's always the goal.
I had somebody call me the other day relative to a property. They were trying to put a deal together and it didn't cash flow appropriately. And so I said, and I'd like to get your opinion on this. I said, the only way you can get, so to speak, past that, so to speak, it was a quick call. I said, number one, you got to pay less for that property. If they're offering for $2 million, you got to pay less. Maybe it cash flows at 1.5, maybe it cash flows at 1.8. But one thing, you got to get the price down in order for it to cash flow. Otherwise, it doesn't make sense doing the deal. The second thing is you need to have some opportunity. If it's not cash flowing today, is there opportunity to do some reasonable value add, maybe some low cost value add to be able to get rents higher so that it can cash flow in a relatively short period of time after you've purchased it. So those were two quick things that I had shared with this investor. I'd like to get your take. Is there anything more, anything you want to expand on that to increase cash flow on day one?
I mean, for day one, because of course after day one, you can lower expenses, you can increase income. But if we're looking for day one, there's only the three metrics, and you hit two of them immediately. You can borrow less money. If you have a lower price, you're borrowing less money. Cash flow goes up.
Yep.
That makes sense. If they're static on price and you can't move it, you look at terms. Is there room for any creativity on a land contract, seller financed? I personally don't like subject to unless you literally don't have a due on sale clause, which happens very rarely. I'm not a big fan of using what's called subject to, where they keep their existing debt in
Yep.
place and you basically wrap around it without informing the bank that it's traded. It's legal, but I don't really like the sleight of hand maneuvers in real estate. To me, it's a way, if you built financial freedom on callable notes and then they get called, that would suck to do it twice. I don't want to earn financial
Yeah.
freedom
Yeah.
twice. I want to earn it once and then be done.
And
So
it kind of goes against the grain in terms of what you like to do. You like to own your property, and having the note in somebody else's name is kind of goes against the grain there.
I don't like when it comes directly to the ownership of the property and the security of my portfolio. I don't like the gray area. I love the creative space. But man, when it comes to title, black and white, I own the debt, I own the property. I'm an anti-subject to guy. Just because it's a clause that it has a use, but it's so uniquely niche. You should know how to use it. And then I would say 99 out of 100 investors shouldn't touch it. There is a use case, but we won't go into that. For general terms, if they're willing to carry a contract, you can, and I know multiple banks that will do this, especially if they're small local banks or credit unions, you can do a seller second. If they can't seller finance a large chunk of the deal, you can always do a really common one is 50-40-10. Bank comes in 50% loan to value in first. Banks love that risk profile. They're like, wait, I'm in first and it's 50% LTV. That's fantastic.
Yeah.
Seller comes in
Yeah.
40% financed. Now you only have a 10% down payment, which is better than any bank term you can get. If the seller's willing to, if they really are married to their price, 100% seller finance, 90% seller finance, 50-40-10. There's all these different mixes you can actually do. Some banks will let you do this, like 60-40, where it's zero down. Seller carries 40%, banks do 60. It's rare, but I have two banks that I've met in Texas who will do this. So if you get the banking relationships, you can actually do zero down deals, that cash flow. That's one thing you can work on. You said something really important, though, that I wanted to touch on. If there is no way to cash flow day one, it doesn't mean your deal's dead. It means you need to sit down and recognize, okay, I'm breaking the rules. Does it make sense to break my rules? There needs to be enough reserve. You want to close it, write a check once, especially if you use investors. It sucks, and I've had to do it one time before. It sucks to call the investors and say, hey, the plan has changed. We all need to figure out more capital. Now, I put in a clause that says there are no capital calls. So when I say there's a problem to my investors, we all have to unanimously agree that we're going to put in money. They don't technically have to. I bear the risk myself of, hey, this is going sideways. They don't have to put in more money. So I close every deal on, we really need enough in reserve. And say it's something, I bought a 26 unit in Texas. Rents were 450. The property manager said there's no chance you can get them above 750. Now, it would cash flow amazingly at 750. However, we believed we can get them to 850. 6 months later, almost the entire campus is rented at 985. We proved them wrong. I put a massive reserve on that property. I overraised by like $75,000 more than I thought I needed. Just in case we were wrong, it would come out of the reserve if it took more time to get income up. Yep. And it turns out we weren't wrong. We actually overperformed. And so what I ended up doing is I took 50,000 of that reserve and I just returned it back to the investor early. I just said, hey, you're earning some money on this, but LLC literally
that's a position you want to be in.
Yes.
You don't want to be in the opposite of that where you're doing a capital call. You're in a position where you're actually returning money sooner than you had promised.
Yeah, so which is a great place to be, but overfund by a little bit. I've found that if you have a project, if I double whatever my reno budget is, that usually gives me a good enough starting reserve. Once I stabilize a property, I like to have 3 months expenses. If I had no one pay rent, which by the way, doesn't really happen in a commercial property, but if I had no income, I could last 3 months on the reserve. That's really the bubble that I like to create.
Yeah.
So I see a lot of influencers online saying you can't cash flow a deal. I think that's the step they're skipping, is they do these deals that make sense on paper, but they buy these older buildings and a roof repair eats the cash flow. The plumbing eats the cash flow. The electric eats the cash flow. And they have to do these contributions while their deal's doing well. Their money is going in, going out. You need to have all the pieces. You need to have a cash flowing deal and ample reserves. And if you could do a deal where the deal works with all of that in place, that is how you build a portfolio that cash flows.
And so I love that word of caution with reserves, making sure you have enough on a deal of those reserves going in, because that's going to just basically save your ass in so many cases. The other thing being going back to the 50-40-10 model. So for the listeners, for the viewers, as you're out there networking, say you're going to a real estate, either a conference or a meetup group, where there's bankers and there's different financiers who are coming to those same meetings. I know there's one locally that I go to, and there's 2 or 3 banks that go to it. Those are the conversations I can have with them to break the ice, to say, hey, if I bring a deal, are you willing to do a 50-40-10 deal with me? And so that's a good conversation to have teed up for when you go to those meetings. So that's a great idea, Christian. Thank you for sharing that. Huge value for the audience. And so I want to transition to the third pain point, because again, I get a lot of questions on these 3. How do you fund a deal? How do you cash flow a deal? And then how do you deal with tenants? I've had tenants. Probably my 2 worst cases is a tenant who almost set my building on fire, and a tenant who had chickens inside the apartment.
Oh,
And
I've had that one. I've had that one.
The more I mention that one to folks, the more I get, yep, I had that too. And
Very
so
common.
it's pretty common, it seems like, for people to have freaking chickens in their apartment. It's so crazy to me. But anyway, there's a lot of problems that can arise with tenants if you don't treat things right. How do you create an environment to have a positive relationship with your tenants? And then how do you've created that environment, if something falls out of that where you have a problem tenant, how do you deal with that, Christian?
Boy, and we've had everything, because I bought some properties. The first property I bought, and by the way, I've cashed out over $1 million on this property. This is the first seller finance deal I did. So this deal legitimately in cash made me 7 figures. Then we're almost $2 million of cash out on this project.
Nice.
So we've done very well on this. It has, in Grant County, Washington, it has the record for most murders at any property. When I say this property was rough, I mean this was super rough. It used to be outside of the county line, and police just wouldn't touch it. It also, back in the 80s, had the largest SWAT raid ever in the county. They had military and the whole 9 yards show up. There was a restaurant in front of it back in the day that apparently was cooking meth. And then again, this was in the 80s. It's been remediated. When we picked it up, the family had run the building into the ground. Now, I buy a lot of Class B, Class C stuff, like C+, that are actually pretty nice. This was the heaviest value add I did. We actually did have someone get, we had a murder in the building in year 2 from an existing tenant who we couldn't get rid of, who had not paid rent for 6 months. It was a delinquent tenant. So when I say we've been through stuff, we've been through drug stuff, we've been through I won't even share it on a podcast. We have dealt with stuff that is worse than tenants murdering someone in their unit. Dealt with one situation that was heavier than that. We have had some of the worst. We've also had a tenant decide to hop on the roof to shovel snow and do like $40,000 of damage to our roof, then
Oh,
break into another one of our buildings, trash the building, and then try to invoice us in court for renovation work. They stole all the trim and appliances, and then they said, "Hey, I was contracted to work this project." I was like, what project? You came in through the window and stole our appliances." We've had some crazy stuff, like
yeah.
some of the most crazy. And yes, I've had the chicken thing was on that building too. We had 2 units, 15 chickens. So yeah, we've seen it all. With tenants,
So there's definitely a phase like when you first buy a property, you're almost dealing, if there are problem tenants, you're dealing with somebody else's problem tenant. So you gotta maybe fix that or get those tenants out. But say you're going to put your own tenants in there.
yeah,
How do you make sure you get good tenants?
yeah. And I've done 29 evictions in my career. Granted, I have a property management company, so I've also managed for other people's projects too. They're not all mine for the management side, but I've done 29 evictions. I have never evicted a tenant that we have placed, and we do the same screening. I do a lot of Section 8 too. We have phenomenal tenants. We look to the extent that Washington State let us. We do criminal background checks. They've banned that in most areas in Washington now, so you can't discriminate based on criminal history, with the exception of you can still, sex offenders, or fortunately, we're still allowed to screen for. But other than that, I do run background checks. We run credit checks. I require a 600 or greater credit score. If they're really close, say they're like 580, I might require a higher deposit if it's a building that's leasing a little slower.
Sure.
But generally
Sure.
speaking, strong credit history, no evictions, no significant recent criminal background history. If it was 25 years ago, people
Yeah.
do stupid stuff in their 20s. I've seen it happen.
Yeah.
The 45-year-old tenant, ethically, they're probably fine. Go ahead and
Yeah.
lease to them, but no recent criminal history.
Yeah.
But the main things I'm looking for is like, if they have an eviction, like absolutely don't rent to these people. If they've missed a car payment recently, they are so primed to miss a rent payment. The big red flags are, do they pay what they owe? And if you see a recent history of them not doing that, don't lease to them. If they're obviously criminals, don't lease to them.
It's a big part of what you're doing there is the background check, right?
Yes.
And so many newbies to this don't run background checks. And before you even get into the business of real estate, go find yourself a background check company, or when you're at your real estate clubs locally, go talk to people. You don't have to have a real estate deal in hand to find out who you're going to use for a background check company to do a third party background. Have that in hand day one before you even buy a property, right? Go talk to people and find out what they're using of quality. Because if you're talking to people who have been in the business for a while, they may have been through 2 or 3 or 4 different background check companies, and they're probably using the best one that's available out there. Why reinvent the wheel and go through that process yourself, trying to find using the first one that's probably of poor quality, and then you move to the second and the third, and finally you land on the fourth one that the other guy's using that he could have told you he was using
Skip to the end, right?
at the real estate club.
Yeah, find a mentor, find someone else in your market. And I'm all for paid mentorships. I've done a ton. And I even run one, but it doesn't have to be that. It can just be someone in your market. Going back to the beginning of this conversation, who's done what you want to do for free, paid, doesn't really matter. Find someone who understands your market and can get you into the right relationships. You can find them at meetups. You can find them. I find them on Google Maps. I look at who owns the building. I drive the street on the little Google map view. I'm like, whoever owns that building knows something I don't know, and I give
Right.
them a call. That's how I built my business.
And go have this conversation with folks. If you're having specific pain points, I mean, today we're talking about funding a deal, how to deal with cash flow issues, how to deal with difficult tenants or finding the tenants. I mean, those are 3 pain points that I brought up because I see them all the time. But to Christian's point, go have a cup of coffee with somebody who's already done what you want to do and talk to them about your particular pain points and ask them very specific questions. This is a podcast where I'm just yakking with Christian about these 3 particular ones. If you have others, go find that person in your area that can help mentor you, or go look Christian up. And I'm sure he's dealt with everything under the sun like I have over the 20 years I've been in business. And I can probably speak to it as well. But it's one of those things where go find that mentor. Don't try to solve these things on your own.
A little piece of bonus content on this. Once someone is one of my tenants, we take it so seriously. Like that really, I want to rent to excellent people, provide better than market housing. Like the properties around me, I make sure that my units are nicer. And I look at them on apartments.com and I'm like, hey, if they're the standard, we're going to have nicer floors and slightly nicer finishes. I'm not saying make this place. I used to way over renovate. I do stone countertops in Section 8 housing. It didn't make me any money, and no one appreciated them. Get a little nicer than the properties around you, and if you
Mhm.
can charge a little under market rent, you basically never lose a tenant. They're like, I can rent a nicer place for less money. They don't really move. You solve vacancy, which is way more expensive than the delta in rent there.
Yep.
Don't get emotional about the people that you are placing until they're your tenants. Then you're responsible for providing them excellent housing. I run into a lot of people who are like, well, I rented to this one person. They didn't quite meet my standards, but they really needed the help. And I'm like, it is almost always a disaster.
Mhm.
People with problems bring problems. They
Yep.
have problems almost exclusively because of their decision making. Almost exclusively.
Mhm.
If they need help, often Section 8 or other programs can kick in and you can work through a program, which gives you some other guarantees. That's why I like using Section 8. I use multiple. There's a group in my area called Hope Source and New Hope.
Mhm.
There's lots of places that work with people who need help, and I work with those places. If you're getting a tenant with a sob story, do not place someone or adjust your metrics because of someone. And I see it happen all the time. And it is like the number one disaster for I let him in and now there's drug dealing out of my building. Not only that, 4 of my Section 8 tenants have now relapsed into drug use because drugs are introduced into the building. I've seen this happen to a friend. Full on cartel takeover because they let 2 tenants in who they knew were
Yeah.
trouble. We're like, hey, we're trying to turn our life around. It's like, your job's not to fix people's life. You're
Yeah.
providing housing and you're
Exactly.
providing excellent housing, and you need to keep every tenant safe. The best way to
Exactly.
do that is to have consistent metrics based on, again, your mentor or other people who've done this. Copy their metrics, never deviate. You can work with people once they're your tenants. If a situation comes up, be kind, not nice. That has been a policy that's worked really well for me. Kindness is huge.
Yeah.
Niceness gets you destroyed. That's the fine line, but very important. And that's
Yeah. It's
we
good
ask
to
that
have
question every time.
it's good to have empathy because
Yeah.
there's a lot of difficult situations going on now. It's nice to have empathy, but you're running a business. You can't
Yes.
put yourself in a bad situation. I share with folks if I'm just not getting applicants of the quality that I want per my metrics. To your point, know your metrics. If I'm not getting quality applicants, one of the big things I go to is I got to drop my rent.
Mhm.
Something I need to make an adjustment. It may just be $50 a month of an adjustment. But now that opens up the field. Now, instead of just getting this many people, maybe now I'm getting many more applicants.
Mhm.
And now I can find somebody who does meet my metrics. So
Yeah.
don't like Christian is saying, don't go after somebody based on you having to manipulate your metrics. Go after somebody who's going to meet your metrics. So that's huge.
And on commercial real estate, if you want to keep values high, this is what a lot of the big property management companies do, and I've implemented really well. If you do a move-in credit where you lower the effective rent without actually lowering the rent, you do get a higher valuation for your property. If your leases are at a higher dollar amount, you
Yeah.
can, if it's the difference between 50 or $100, and you can basically just be like, okay, well, if we did $50 off the rent and we just applied that amount towards a move-in credit, same for the tenant, looks a little bit better for
Yeah.
your books to have the higher lease. Move-in credits
Yeah.
are the first thing that I go to. Is I just go half off first month's rent. Credit is credited to the second month rent because I do want to get them in the habit of actually paying their rent.
Yeah.
But simple things like that, always make the adjustment on your pricing, not on your qualifications. Don't let an unqualified tenant into your building because it can
Yeah.
be, well, especially in like Washington State. If you happen to be in a blue state, it typically
Yeah.
is much more expensive to evict. Not being
Yeah.
political, just
No, it
how it
just
works.
is. If you're
Five
operating
grand
in
is
a
what we budget for getting rid of
yeah.
people. 5 grand, 3 months is what we budget. And sometimes we get them out for 3 grand in 2 months, but that's the minimum. So it's like it's really expensive if you play someone who doesn't pay. Like
Yeah.
ungodly expensive. You're like, well, I lost like half a year's rent from this person in expenses. Now, when I get a new tenant, their first 6 months is going towards paying the eviction.
Yeah.
It can really
Again,
wipe you out. So you got to be strict
a-
on these.
again for those new investors out there, and that could mean if you already have 1 or 2 or 3 buildings, great. But again, learn from others who have done what you want to do or do more of. Learn from their experience. I mean, this podcast was gold, Christian. I
Thank you so much.
appreciate having you here. We talked about a lot of pain points plus some. So thank you for being here. Again, where can people find you, either on social media or your website? Where's the best place for people to connect with you?
On Instagram, I'm at Christian Osgood. I happen to have a unique enough name where I actually just make my name my IG, which is very helpful. So at Christian Osgood on Instagram. You can check me out on YouTube. We have like 100. I think we crossed 110,000 subs, which is just a huge blessing.
Amazing.
It
Congrats. That's awesome.
thank you so much. It's been it's a fun place to share. I share everything for free. If you're looking for a mentorship or a community, we have that on multifamilystrategy.com. You're welcome to check that out. But if you just want to get a feel for like, what is this about? You want just the information that lives on YouTube, Multifamily Strategy. Would love to see you there. And we talk a lot of creative finance operations, and I share a lot of these hilarious disaster stories. We share the whole journey there. So
We all have them.
check it out.
We have good and bad. So
Yes.
it's good to share it because it's important for folks to realize they're not alone in this. We've
Yes.
all, been through parts of this. So it's a community and we can all relate to each other. So it's important to share some of those stories. I didn't always get it, and I don't always have the answers. We're all trying to figure some of this out real time as well, facing into like a new economy and where things are going. So we're all trying to figure this out together. So
Yeah.
join Chris at that YouTube channel, Multifamily Strategy. Look him up, Christian Osgood on Instagram. Christian, I'll make sure your links are included in the details here. But thank you so much for your time. I really appreciate you. Any parting words?
If you're listening to this podcast and you're newer, this took me 8 years to figure out, so I'll skip to it. If you want to be an investor and you haven't bought a property yet, the only way to do that is to buy a property. It is not becoming a broker. It is not getting a property management job. It's not working for the CoStar Group like I did for years. Don't add steps. The only way to become an investor is to invest. You're going to learn a million times more on your first investment property than you will in a decade of study. If you want to go out and do the thing, find someone who's done what you want to do. Go buy your first property, get your hands on it, and start going.
Beautiful. I love it. Christian, thank you so much for your time today. Truly appreciate you. Thank you.
Thank you for having me.